Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the program, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate and mortgage markets will be covered here. If you got credit issues, you got, silly collections, parking tickets, medical collections that could be holding you back from potentially buying a house because it's your credit score, instead of being up over 700, these collections have your credit down in the 580s, 620s, and you're looking for somebody that can help you, that can truly be upfront and honest and help you get those silly collections removed. We can help you out with that. If you're looking to refinance to the lowest rates in U.S. history, they've obviously been rising over the last couple of weeks, but still in a great low range. I mean, you're talking anywhere from 3.5, sub 4% interest rates, depending upon your qualifications. We can put you in touch with a local lender that can, help facilitate a refinance or a purchase transaction for you. And if you're looking for a real estate agent, a local real estate agent that can take care of you and get the highest net if you're looking to sell a property or guide you through the home buying process, we can help you out with that. Please call us at the All Fair phone number. It's 877-245-2030. That's 877-245-2030. Or you can go to the website at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. I've got a great show lined up for you guys today. Joining me on our panel to discuss what happened in the markets last week, as well as what's on deck this week that can affect you and your real estate decisions, is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, and yourself, Ryan?
I'm doing well, thank you, Louis. Obviously, we'll jump right in. Last week, we touched based on the Fed meeting and what was going to be said, and we had the employment numbers come out the day later in the week. Interesting, ahead of the negative employment numbers, you remember how you and I debated whether would that information be leaked to the Fed prior to the unemployment report? It seems as though it was, because Bernanke changed pretty much from the December minutes and now the January minutes that have come out. It's basically like he's changing his tune back to, we're going to keep interest rates low for an extended period of time. No more of the talk of cutting the program off in 2013. It doesn't look or seem as though, based upon his comments, that they plan on doing that. I just find it very ironic how, it's almost like, okay, let's prop up the stock market real quick, and then, okay, but, things aren't really that much better, so now let's go back and say, hey, we're going to keep interest rates low for an extended period of time.
Which also props up the market.
Which also props up the market, correct. What are your thoughts on what was said in the meeting and where you feel like we're heading as far as the Fed's decision to keep interest rates low?
Well, look, this was all predictable. We talked about this. We said that what the Fed would do was start to talk down QE3 or quantitative easing, and then they would have an excuse not to stop QE3. And that excuse comes now in the numbers that we saw on unemployment. It's risen to 7.9%. Remember, the Fed has said that 6.5% is their target for when they stop QE3. Well, we're moving in the opposite direction. Then also the GDP number came in negative. That now gives Congress an excuse to continue spending because they peg the blame on the decrease in the GDP on a decrease in government spending, which is ludicrous because government spending is at an all-time high. So you and I have said all along this is not really a recovery at all. And, in fact, if we have another negative quarter of GDP, lack of growth, then we're back into a recession. And, of course, the Fed can't have recession, so the quantitative easing will continue. They'll continue to print money. The stock market will continue to go up. But keep in mind that the stock market is going up in nominal terms. We just passed 14,000 Dow, and that's back to where it was in 2007. Not based on the fundamentals, but based on the fact that investors have really nowhere else to go when interest rates are low. So they have to put the money in the stock market, and then it feeds upon itself because there's some momentum that the stock market's going higher, and the Fed can now say the stock market's higher, the housing prices are improving, see, we did our job, we spent trillions and trillions of dollars. The Congress can say, see, we got ourselves out of the recession, and really nothing changed other than they put a tremendous amount of money into the system.
Yeah, and for those of you listening that are, still kind of confused by the whole quantitative easing. I know you probably hear that as a generalized term all the time in the media, and how that actually, what that means for you, like as far as mortgage interest rates. Well, what it is the Fed's actually buying mortgage-backed securities and Treasury bonds. Basically, they're buying all of the government debt as well as they're buying pretty much all of the mortgage-backed securities that are being issued out there. So right now, there's about monthly purchases of about $45 billion in Treasuries, which is the government debt that's being issued, and about $40 billion in mortgage bonds that they're buying. So they are basically the biggest buyer of mortgage debt. Okay, so they're able to continue buying, and what this actually does is it basically keeps interest rates artificially low.
Now, it would be okay if they were a purchaser who was buying them for investment and had saved up the capital to buy them, but keep in mind that they get the money just by inventing the money, printing it out of thin air in order to make these purchases.
Yeah, absolutely. So it's basically, money that's coming out of thin air that's now buying these mortgage-backed securities, which is then, forcing interest rates low, but it's artificially low. Like you said, these aren't investments. This is just a tactic to keep interest rates low so that they feel like, okay, well, if we at least have housing somewhat moving, then it'll, keep the economy going. Because, basically we haven't ever really came out of any depression without, real estate headed in the right direction. And it's interesting because, they continue to have their balance sheets rise. But, not all of the Fed, the people on the Fed committee were in agreement with, continuing this basically policy. I believe it was Kansas City Fed President Esther George dissented from the statement, saying she was concerned that continued high level of monetary accommodation increased the risk of future economic and financial imbalances and over time could cause an increase in long-term inflation expectations. Louis, you and I talk ad nauseum about, long-term implications of inflation, but for people right now that are out there looking to purchase a home or refinance their home, whatever it may be, if they're in a position, meaning they have some equity in their property, their credit is somewhat okay, they have a stable job, and they're able to take advantage of these artificially manipulated interest rates at this point, then, it's a great opportunity. And for investors out there looking to, that are able to qualify for mortgages and buy investment properties and lock in the pretty much all-time low interest rates, it's just a fantastic opportunity that, while on the flip side, I feel like it could have terrible long-term implications. If you're able to take advantage of it right now, please do.
And also, Ryan, the prices of the homes, if there is inflation, will continue to go up in nominal amounts, but your mortgage payment will remain the same.
Absolutely. So, if you just look at things from a rental perspective, if you're renting a home right now and you're paying $1,000 a month, and obviously inflation is happening all around us. We have, especially in the D.C. metro area, we have rising rents. So let's say you're paying $1,000 now, next year $1,100, next year, the year after that $1,200, $1,300, and so on. If you have a mortgage that's locked in at 3.5% per se, and with taxes and insurance and everything, your payment is, let's just call it $1,100. I'm just making up these numbers, but that is going to be consistent for 30 years. The only thing that can change in your payment is obviously your real estate taxes and your insurance. But you're locking in that long-term debt for 30 years. That gives you stability. And at this point, the market definitely does need some stability. And if you're able to take advantage of these interest rates and lock in, all-time low interest rates, then it makes sense for you and your family to do so. Now, if you're only moving to the area, you're only going to be somewhere for a year or two, then it might not make sense to buy. But it still might. If you're looking at it from an investment standpoint, where you could potentially buy with a small down payment, lock in a low fixed rate, let's just say in sub 4%, 3.53 was the Freddie Mac average for last week, 3.53%, which was up 0.11%. So if you take that as the average, so we'll use 3.5%. You can lock that in for 30 years, even if you move in a year or two, and you want to use that as an investment property, and you can go buy something else when you relocate somewhere else. That's one of the biggest trends that I'm seeing right now, Louis, is that people are finally realizing that it's like, wow, these interest rates aren't here to stay. I really need to take advantage. Even if I only plan on staying in this house for a couple years, I could use it as an investment property down the road. I had talked that I feel like that little shift upward in rates was going to push a lot of people off the fence, and I really think that it has. Now, I don't know why it took that, but I guess people kind of look at things like, the rates can always go lower. When they took the reverse movement and went higher, and they went higher much faster than most people thought they would go, people got scared and were like, well, I got to get in.
Well, you know what it is? The greed side on the downside isn't that high because you can't really expect interest rates to drop that low. But the fear side, the fear that they might go higher is much greater because they can go 2-3 points higher, whereas they really can't go 2 or 3 points lower. So the fear motivation is higher than the greed motivation that they'll go lower. And I just checked the 10-year note is now up to 2.05, and that's really basically up from 1.92 or so just a couple of weeks ago.
Yeah, absolutely. I mean, it rose relatively fast. Now, I'm getting the question all the time right now. Okay, well, do I think that interest rates are going to trickle back down another eighth or a quarter? You know what? I think that there is a possibility of that happening because I feel like the stock market is just overbought at this point. But I can't really, say that clear cut it's going to happen because a lot of the indicators that I would normally look at aren't holding true. You know what I mean? There used to be some sort of consistent patterns that you could look at that would say, okay, if the stock market's doing one thing, that the bond market's doing another, but they're not trading in normal patterns anymore, and it's because there's so much artificial manipulation. The stock market is paying so much attention to the Fed, and they're just not looking at everyday economic indicators. It's really hard to say. I would venture to say at this point that we could get a little bit of a pullback because we're due for one. Rates have risen, so much over the last 2 weeks that I feel like we should get a little bit of it back. With all that being said, I would, if you're out there, I would still protect yourself and consider locking in. Don't risk it. This week, obviously, there's not near as much economic news as there was last week. So I don't feel like there's going to be too much that can really sway interest rates up or down.
Well, you got another employment report.
You do have the employment report, but obviously after we're coming off of the unemployment report from last week, and we did get a little bit of a better bump for interest rates to the downside. They got a little better last week.
But it didn't make any sense that they did because very few jobs were created and the unemployment rate went up. It seemed like there was almost a concerted effort to talk up the bad news because last year at this time we were creating over 300,000 jobs.
Yeah, it's interesting
so the rate of employment is not really ticking up, and actually, if people aren't getting jobs, that gives the Fed an excuse to pour more money into the system and continue quantitative easing.
You're 100% correct, Lewis. We're up on a break. When we come back, we're going to let you know FHA plans on raising mortgage insurance premiums again in June. So another reason why you should consider buying now. Stay right there when we come back.